Good morning, good afternoon, good evening, wherever you are. Thank you for joining us for today's public webinar. As you've heard Jim say previously, we do these public webinars to promote our courses. And the next live course that we have is the Market Profile Primer, which runs from December 6th through 14th. If you're new to us, if you're not familiar with our website, if you go to jimdeltontrading.com, you can see here that we've got our official YouTube channel link here. Right here, and Twitter, or X, I should say, here. And if you haven't already subscribed to our emails, you can do so right here. The primer, you can go to courses, and then you'll see that the primer is featured up at the top. But if you look at the primer page specifically, kind of gives you an outline of what we'll be covering for this 8-day course. But this course, if you're wondering who it's for, it's really for a large number of people to discover if market profile is for you, if that's something that you're, if you're completely new, or if you're somebody who already has some knowledge but wants to make sure that you understand the basics as Jim intended, or you're a previous client and you're just wanting to make sure that you're keeping your basics up to date with regards to the current markets, because the first 4 days is the linear teaching portion from our foundation e-course turned into this live course, and the latter 4 days is Jim narrating the market and showing you how the pieces get put together, and we also provide our daily reports. One thing that also sets aside the primer from our foundation e-course is that we have a day where we plot the profile manually. So if you're somebody who does not have market profile software, no worries, you can do it manually, and we do that as an exercise during the primer as well. No worries if you're not able to attend all of the sessions live, as all of them are recorded, and you will have access to materials for 3 months after the course ends. Okay. Good morning, Jim.
Thank you. Thank you.
Let me give you the screen.
Please.
There you go.
Okay, I'm going to start off by showing my bar chart. If you see the break, when this market came down, there was no backing and filling. In other words, the market didn't come down, move sideways, come down, move sideways, come down, move sideways. It came way down. It got overextended. When this happens, it's usually an indication of serious emotional selling. The momentum indices are showing negative and everybody is piling on board. This is always a very dangerous environment, because when the market gets too short and the emotions, it can go the other way very rapidly. Now, and the reason I'm pointing this out is this run to the upside is even worse than the break to the downside. Again, there's no backing and filling. There's a gap. There was a gap here, here, and here. 3 gaps is about as big as it gets. The risk, nobody knows what's going to happen, but the risk of being long is huge. The healthy thing would be for the market to back and fill, spend some time down here, build a base. The longer it goes up here, the riskier it gets that there's going to be some kind of catalyst that starts this market to the downside. So that's my only point. You see how the market came down? No backing and filling? Look right here, the market goes up, no backing and filling, and you see what happens. Came down too fast here, see what happens. So this is my alert, and I understand that all the momentum indices and everything else, are showing very positive. And the market's, right at that 4,000 level. My caution is be alert, because the risk of being long is huge. It doesn't mean we're going down. It just means the risk is very, very large. Now, when we do these educational programs, I want to read something to you. This is years ago, I read a book, and the book was "This Is Your Brain on Music." I didn't know what one was at the time, asking me what the band wanted to sound like. He taught me how much of a difference to the sound a microphone could make, or even the influence of how a microphone was placed. At first, I didn't hear some of the differences he pointed out, but he taught me what to listen for. I learned to hear things I had never heard before. The difference between one microphone and another, even between one brand of recording tape and another. Ampex 456 tape had a characteristic bump in the low frequency range. Scott's 250 had a characteristic Christmas in the high frequency. Blah, blah, blah. Once I knew what to listen for, I could, and it goes on and on and on. What we do in our educational courses, the majority of people that trade are focused on momentum. Momentum is simply price-based momentum. What we do is we put context around momentum. We respect momentum, but we put context around momentum. We teach you what to look for. In our courses, it's what are the things that you should be paying attention to. For example, what I just showed you this morning, this just tells me the risk is really great. So we can show you and teach you what to look for. What we can't do, what is self-taught, is how you start to integrate the pieces in order to make rational trading decisions. It's not easy. The majority of people, just want to know where to buy, where to sell. The majority of people are not successful as traders. When I had a discount futures brokerage firm in Chicago, the average account lasted 7 weeks. So when you talk about, addressing this for education, we sit there and point out the things to look for. So much of the others, how you put it's market understanding plus self-understanding. The market understanding is easier. The self-understanding is very difficult because of the emotions and FOMO and those things. Okay, so before we take questions, where we are right now, as I pointed out, the break was extensive here with no backing and filling. That set the risk up for a short covering rally to be huge. Right down here, and we break this down, when this is coming down, what we call the dispersion model. The early adopters or the innovators.
Diffusion.
Pardon?
Diffusion model.
The diffusion model. The innovators, early adopter, early majority, late majority, laggards. These were the laggards right here. As you start to go up, you get the innovators. In this case, the innovators were probably buying from the laggard sellers. As the market goes up, the innovators, early adopters, early majority, late majority, and my guess is we're now back to the laggards. That doesn't mean the market can't continue, but the risk reward is absolutely huge. Okay, Jen, let me take some questions.
Okay, in your experience, how do markets that move in this way, missing prominent POCs, multiple gaps, no backing and filling, etc., get resolved? I'm seeing things on social media about breadth thrusts, new bull markets, but under the hood, this move does not seem healthy. How do moves like this get resolved given your decades of experience?
Oh, it usually takes some kind of catalyst. Everybody gets complacent. Nobody wants to be first. For example, right now, the market, it's almost exactly at 4,000 or the 4,400 level, almost exactly at the 4,400 level. Very mechanical. At some point in time, there's some kind of catalyst, or the selling starts, and then it starts to feed on itself. And you get the same kind of panic you got going up, you get the same kind of panic going down. You've got two views out there. One view says, oh, we're in a new bull market, a seasonal rally, we're going to, new highs. You've got another view out there that says the underlying strength of the market is weak, and they're pointing at earnings, etc. But one of the things they point at is crude oil. If the economy and all that was that strong, you wouldn't have crude oil down in the $76 a barrel level. Again, the other day you had the Saudis come out saying things, trying to support crude, and there's no takers. So you can easily find two groups. One of the things we have read and looked at over the years is what does so many traders in is reading the financial press. You go back and look how many times they're right or wrong, and they usually report, one-liners and what they hear from people. Okay, what else?
Are there 4 gaps including the overnight from Sunday, or am I mistaken?
No, I don't count the overnights from Sunday. I just count on the day. I remember, I don't think this shows on the bar chart, but there was a 1 or 2 tick gap here, gap 2, gap 3. Now, you never had any real excess up here at this gap. I mean, this is just a couple of ticks up here. So the confidence has not been high going down or going up. The big, got a lot of price movement. You got a lot of price movement in here, but you haven't had the good volume. And like I say, the backing and filling that gives me far more security. Okay, what else?
Okay, would you say that the current rise is a short covering rally, or that long-term money buying?
I see no evidence of long-term money buying. I mean, there's always some in there, but I just basically it's short covering from what I can see. And matter of fact, yesterday's market was a crazy market yesterday. If you look at the individual stocks, the individual stocks that were really getting run up yesterday for an awful lot of corporate stocks that had bad earnings, that had shorts on them. The market gets going and they go after the shorts because they can squeeze them. Okay, what else?
On October 27th, the ES bottomed. On the daily chart, there's an excess at the low. Would Jim consider this to be an entry for a swing trade, even though on the 30-minute chart there was no excess, but rather a poor low? The 30-minute poor low was evidence that the market was too short.
Yeah. Remember, when there's no excess on a low, a lot of times that is an indication of a market that's too short. Just think about sometimes when you're caught short, boy, the market goes down to the low for today. I say, oh, thank you. Okay. Jen, why don't you do another short commercial, and then I'll take a couple more questions and make a last comment on the market.
Okay, 1 second. Let me take the screen back. Okay, so something that I forgot to mention earlier is that specifically for this primer, if you don't have market profile software, for the first time, Window Trader is going to be offering a free trial of Window Trader Blue for 1 full month to students that sign up for the December primer. The other eligibility criteria is, that you're signed up for the primer and that you are a new subscriber. So that's a $285 savings with regards to that. And we will be having, a couple of support webinars with regards to signing up properly for that to take advantage of the offer, as well as getting charts set up. So if that's something that you've been interested in, now would be a great time to join us for this primer because of that offer. If you go to our courses page, like I said, you'll see the primer featured up at the top here. We also have our schedule posted. They are in Eastern time, so that you know the timings of our webinars. And like I said, everything is going to be recorded, and you'll have access to materials for 3 months after the course finishes, so that you have time to review. If you've got any questions about which course is right for you, or clarification questions on any of our courses, please feel free to contact us. You can contact us at dalton@jimdaltontrading.com, or give a call here, and I'd be happy to speak with you. Okay, do you want me to give you the screen back, Jim?
Please.
Okay, second. There you
Okay,
go.
let me say one more thing about the primer coming up. The first 4 days we teach in a linear manner. Linear teaching is not my favorite, but it does give you a base to understand the basics. The last 4 days, we interact with the market. I do reports at the end of the day, recap the day, and it's working with live markets. Okay, so questions that are remaining out there, Jen?
Okay. Okay, somebody's asking about, do you use moving averages for references or for taking positions?
I don't. The two parts of the question. I am aware of the, particularly the 200-day moving average. I do look at the 100 and the 50, but I don't use them to take positions. In one case, if the circumstances are right, I might. In another case, I might not. Everything's a series of facts surrounded by other circumstances. So for example, if let's say you're long and you go up to one of the moving averages. If you go up to that moving averages on decreasing volume, that's probably a place that you might want to get out. If you go up to that moving average on increasing volume, then it may, it's a different set of facts and circumstances. So there's never a simple answer to the questions. How did it get there? Did it get there on high volume? Did it get there on low volume? Did it get there on high confidence? Did it get there on low confidence? So how things happen is far more important than what actually does happen. Okay, other questions?
Hi, Jim. The volume on the ES the last few days has been pretty low. Does it add to your downward bias?
Yes. Now, when we say downward bias, make sure you understand it. To me, one of the things that is really harmful to us as traders is we tend to lean into the trade. So if you say, do I think this market is susceptible to a break? Yes, I do. That is different than being short. One of the things that you'll hear from me so often, and it's hard to contain yourself, is you are usually better off to be a little bit late rather than early. It's amazing. Take, this current market, take how far momentum can take it. So a lot of people are afraid they're going to miss the move, but if the move starts to the downside, it's probably very large. So your risk is probably much better by letting the move get underway rather than trying to lean into it and make sure you don't miss it. Okay?
Okay. Do the highs from the balance area of October 10th to 17th look weak to you? There's a gap above, and I'm wondering if traders are focusing on the gap.
Oh, I think they're probably looking at the gap because, as I said earlier when we started this, there was only a couple ticks of excess up there. There was never any really good, what you got was liquidation there. You didn't get an indication of liquidation and new money selling, which increases the odds that you're going back there. But where you are right now, it is a gap, and look at the gap as single prints. So the gap, you can look at this as single prints and this. So there is, a little bit more excess than it actually looks like there. But, you take this very mechanical because you don't know what markets can do. And markets, a lot of times it takes some kind of catalyst or some kind of statement to actually get the market, to reverse where it is. The momentum is very, very strong. And, what are they looking at this morning? They're looking this morning at the 4,400 level. Final question.
Okay. What confirmation do you look for to know when to enter a trade?
Nobody rings the bell. Nobody rings the bell. You'll see an excess high. You'll see the market start to gain momentum to the downside. You'll see some kind of break. You'll see some kind of confidence in there. But it's, and that's what I said before, we can teach you what to look for. But the integration in your mind, it's a combination of market understanding and self-understanding. And so many times, once the break starts, you've seen it going up and you say, oh, well, I'm not sure about it. Well, those are the kind of things that a lot of times traders find it difficult. They think, oh, I can't miss a trade. I can't chase this. And one of the things that we talk about and teach so much is monitoring for continuation. There's so many trades you can do if you learn how to monitor for continuation. You don't get the continuation, then you get out of the trade. But that is a skill that you build on, and it will allow you to do a lot more trades, and it will take some of that fear away that we get so many times psychologically. Let me say thank you very much. I will say this. Today overnight inventory is fairly well balanced, but you have a very prominent point of control. The more prominent the point of control, the greater the odds that the market will revisit that point of control. Thank you very much. Have a great trading day.
Okay, and there's a couple of questions here that RJ and I will stick around to answer.
Okay, thank you.
Okay. See you later, Jim.
Bye.
Okay. Somebody's asking about, there's a chart question for TOS, I think, and then there's one about the primer. So somebody's asking if the trial will start today or when the primer starts. Hold on one second. Let me take back the screen. Okay. Can you see my screen? Okay. Somebody's asking about, will the 1 month of window traders start like today, or would it start when the primer starts? So you need to be signed up for the primer, and you need to be a new subscriber in order to qualify for this offer, a new subscriber to Window Trader. And we're going to be having a couple of support webinars on exactly how to sign up correctly so that you can take the best advantage of this offer. And as well as, the data feed that you need to have in order to power the charts. So if that's something that you're interested in, you need to sign up for the primer, and we will be subsequently sending out more information. And we will be having a webinar very soon with regards to signing up and the steps and everything with regards to that. Okay. There's another question here. The value of my 50 and 200 SMAs are different than yours. For example, my 200 SMAs are around 42.80, whereas yours is at 43.60. RJ, are you there? I will give you the screen and you can explain about that.
Yes.
Okay, 1 second. So we use Thinkorswim, which is TOS, aka TOS. And one of the issues with using that is the adjustment when there's contract rollover. RJ, you can explain?
Yes. So you'd get 42.80 if you do not select this adjust for contract changes. And if you select adjust for contract changes, you'll notice that the 200 SMA jumps up to 4360.58. And that was the low on this particular day here. So it's just the setting, chart settings, futures, and select adjust for contract change. Other thing is we do not use this show extended trading session. So make sure that is unchecked too.
Right. Okay. Okay, well, I hope that answers that question. Thank you very much for joining us for this webinar. Like I said, if you have any questions with regards to any of our courses, by all means, please contact us, send us an email or give us a call. And like I said, the primer runs from December 6th through 14th. You do not need to have any market profile charts in order to join us for this course. And like I said, it might be a nice time to join us for that and also be able to get the free trial of Window Trader Blue if that's something that you're interested in. Okay, thank you very much. Bye-bye.